Okay, here we're going to look at stock subscriptions. This is where we sell stock on the installment basis. The potential stockholder makes a down payment here to purchase some stock. Then we set that stock aside in a special account here called subscribed stock. And then after the final payment is made by the stockholder, we move the stock into a regular stock account, and then we issue it to the stockholder. Now, for our accounting here and on our equity side of the equation here on the balance sheet, using the par value method, we set up a common stock, a subscribed account here for the par value. And then the excess over the par value here, we use the additional paid-in capital here for common stock, and that's for the subscribed common stock. And then over on the asset side of the equation here, we have this cash account, and that's for the actual cash receipts that we made. That would be for like the initial down payment and like for the final payment. And then we have to set up here a contra equity account, and that would be like an accounts receivable, and we call it a subscription receivable. This is the amount that's still due from the purchaser of the stock. And that's set up here as a contra equity account because the SEC requires it, this receivable to be reported as a deduction of equity. Normally we would set up our accounts receivable on the asset side of the equation, but because of this requirement we set it up here as a contra equity account. And this subscription receivable really is based on a future event here, and it may not be collectible in the event that the potential buyer of the stock backs out and decides not to purchase the stock. Okay, accounting for these stock subscriptions, we have to be concerned with the contract date, the collection date, and also in the event that there's a default or the purchaser of the stock decides not to buy the stock. So starting out here with our contract date, this is where we agree to sell a certain number of shares of stock at a specified price. So for the example we're going to go through here, I'm going to use the par value method here, where we got $2 par stock, where we agree to sell 1,000 shares of stock for $10 per share, and we're going to require a 40% down payment, and then 60% will be paid later. So looking at our stockholders equity account here for our common stock subscribed, this is where we would subscribe 100% of those shares. So we take the number of shares times the par value here for our common stock subscribed account, and then our additional paid-in capital, that would be the excess over par, and that where we'd be taking the number of shares that we agree to sell times the difference between the issue price and the par value of that stock. And then going over here to our asset side of the balance sheet for our cash account, we'd be increasing our cash account here by the number of shares times the issue price, or that agreed price that we agreed to sell that stock at, times the percentage here that we want as a down payment. In this case it's 40%, and that's what we're going to receive now. And then over here back on our stockholders equity for our contra equity account, we'd be using the subscribed receivable, and that's of subscribed common stock in this case. And this is the amount that we're going to be receiving later. And we agreed in this case that we're going to be they're going to be paying 60% of the value of that stock later. And in this case we'd be looking at the number of shares times this issue price, or the price we agreed to sell that stock at, times 60% here. That would be the amount that we agreed to receive as a final payment. So looking at our balances here, we'd have a credit balance in this case of $2,000 for our common stock subscribed, and then we'd add another credit amount here for that additional paid-in capital of $8,000. So we have a total credit balance here of $10,000. And then looking at this contra account here, we'd have a debit balance of $6,000 in it, and then adding that to our debit balance here in our cash account of $4,000, we'd have a balance here between our assets and our equity. So the $4,000 plus the $6,000 is $10,000, and that adds up to additional paid-in capital here of $8,000 plus the $2,000 in this common stock subscribed account for a total of $10,000. So we've got a balance. All right, let's look at this stock subscription at the collection date. This is where the final payment was received and we issued those shares to the purchaser of the stock. So what we would do here is we'd close out these common stock subscribed accounts and transfer them into the common stock issued accounts. So for our common stock subscribed here, for the par value, we'd be debiting that for, in this case, $2,000, and then for the common stock issued account here would be crediting or increasing it here for $2,000. And then for additional paid in capital here, we'd be closing it at a common stock subscribed here or debiting it for $8,000, and then we transfer it here to the our additional paid in capital here for the common stock issued, credit that for $8,000. And then for this final payment, we'd be reducing here the subscription receivable by crediting that for the $6,000 payment that was due, and then we'd debit our cash here for $6,000 for that final payment. So the final amount we received here was $10,000. That was the $4,000 initial down payment plus this final payment here of $6,000. So in summary, we've closed this common stock subscribed accounts to this common stock issued accounts here, and we've also recognized here this final payment by reducing our subscription receivable and increasing our cash account for that final payment. Okay, let's look at a stock subscription where we had a default on the sale. That's where the potential buyer of the stock decided not to buy the stock or he backed out. And let's assume here for our contract that the issuer gets to keep any previous cash received. So this previous amount that we received here for the down payment on the contract date of $4,000 we get to keep. And the point I want to make here is where we recognize that cash that we get to keep here. And we do that in additional paid in capital or common stock. That would be the regular additional paid in capital or common stock, and that's on our stockholders equity on our balance sheet. So we would increase this additional paid in capital here for that $4,000, or we'd credit it for $4,000 for that initial payment here that we get to keep. And then for our other accounts here, for our subscribed accounts, we'd just be closing that out for both the par value and the subscribed amount here. And we'd also close out this subscription receivable because that would no longer be due to us. Okay, to summarize this stock subscription, at our contract date, we'd be setting aside 100% of those shares that we have under contract here in a common stock subscribed account, and additional this paid in capital here to subscribe for that common stock. And then we'd recognize that initial cash payment here in our cash account, and we'd also be setting up here a subscription receivable for the final cash payments that we have to make. And then at the collection date, we'd be transferring this common stock subscribed into a common stock issued account where we'd be issuing it to the buyer of the stock. And then we'd also recognize this cash payment here that we received for the final payment, and then we'd reduce this subscription receivable for that final payment. And in the event that there was a default and we got to keep the initial cash payment here, we'd increase our additional paid in capital here for our regular common stock account for that amount.